Hello and welcome to the show. We call this Molotsky on Money. What's the show all about? Well, the clues are in the title. We'll be discussing money, specifically investment strategies, taxes, estate planning, insurance, and many other topics, all of it designed to help you and your family improve your overall financial picture. The Molotsky part of our title comes from our panel. Their name is Molotsky. Each week we'll have Stan Molotsky, president and founder of the SHM Financial Group, as well as Lee Molotsky, vice president of the SHM Financial Group. We invite you to stay tuned because we have a lot of valuable information on this show and every show that we hope you and your family can benefit from. And Stan, as we like to say, tonight is no exception. We're going to be talking about a lot of things here, but specifically I know a lot of things that you do in your firm is you set up clients to be able to eventually retire and retire comfortably. Hopefully in the lifestyle that they lived before they retired.
Correct.
That's pretty much
That's the goal.
The main goal of what you do.
That's part one, and part two is to make sure that under every set of circumstances, they will always have enough money so that they do not ever outlive their money. That's the goal, that's the key, that's what we try and do.
All right, and as part of that, we like to do our best to educate you here on the show. Part of that is really to explain some areas where they might have made the wrong turn. Not necessarily your clients, but people may have made a wrong turn based on whatever or not knowing.
Well, sometimes things happen. You can be driving up from the shore and all of a sudden they change the traffic pattern because there's construction or there's a storm. And those things allow you or force you to make changes, to go a different direction, to get from here to here or from there to there. And it's the same thing in financial planning. There's constant bumps and things along the way that force you to make adjustments. And that's our goal, is to help the client make those adjustments so that, like you said, they can continue to live in the style to which their spouse has made them accustomed.
And we're calling tonight's show Reasons That Your Retirement Calculation Could Be Wrong. And before we get into our list, I wanted to ask you, Lee, can you think off the top of your head quickly, like what is like the number one thing that people do wrong when it comes to setting up a retirement plan?
They take the advice of their neighbors.
We've talked about that on the show. How about the neighbor, the plumber, the brother-in-law, the sister-in-law, the cousin, and you could the list can go on and on, right?
You know that things are going to change once people start hearing things from their barbers and their neighbors as to what to do with their own personal money. Not knowing no risk assessment, no goals and objectives, no tax bracket discussion, no estate planning issues, no anything. It's just should we buy this? What do you think of that fund? Blah. The end is near when that kind of stuff starts happening.
And we're going to do a show on selling stocks, but I know that's another one, Stan. People say, my neighbor told me about a stock. Stan, we got to buy this stock.
We hear this, especially in certain phases of the market cycle. You hear it more and more.
Right.
Yes.
So we're calling, as we said, Reasons That Your Retirement Calculation Could Be Wrong, and this is number one. And we'll go through these one at a time here on the show. What age will you and your spouse, if married, retire? And we have here voluntarily, unexpected sickness, or layoffs. Stan, do you want to kind of explain what you mean by that?
Well, no matter where you are in your life cycle, at some point, especially as you get closer to that quote mythical retirement age in your mid-60s, you start to think about, will I have enough money, and what will be that age when I quote do retire? And sometimes you're forced to retire earlier because of health, or you're forced to retire earlier because of layoffs, or you have to move from where you live for whatever the reasons, and that causes you to make adjustments along the way. So as you get closer to those dates, you have to think about planning for the monies that you're going to need when you do retire. And the goal basically is shoot for some time in the early to mid-60s to plan accordingly and then make adjustments as you have to.
When are you retiring, by the way?
Never. Fortunately for me, I love what I do, and as long as I can keep doing it mentally and physically, the changes in this industry are unbelievable. The opportunities that we can present to people today are so much greater than they were 5, 10, 15, 20, 30 years ago, that it's just exciting. So I love what I'm doing, and for me, my wife would have it no other way.
Right.
I'm going to
Keep
keep
working.
Keep
Okay,
working.
keep working.
Keep doing what I'm doing.
Lee, you wanted to add something to
I was
that?
going to say one of the most interesting things today is the discussion of which I don't think occurs often enough about when should we elect Social Security, because Social Security for many people today is a large percentage, makes up a large percentage of their retirement income. And relatively little, if any, planning goes into most people's decision as to when to take Social Security. And
Which goes into the question of when do you plan to retire, you and your spouse, correct? Because
Yes.
that's kind of tied in.
Yes, significantly. So we have developed with one of our back office groups a Social Security maximization report, which is really fascinating. You can retire anywhere, you can take Social Security anywhere from age 62 to age 70. 70 is really the maximum age. And so there's 8 years where you can take Social Security. There's 96 different months over that 8-year period which you can take Social Security. And there's a lot of factors that go into deciding when you should actually take Social Security in order to maximize.
So this
Effective.
point one, what age will you and your spouse, if married, retire? That's
to me,
kind of a corollary to that, correct?
To me, it has a lot to do
Right.
with going through that systematic, Social Security maximization report, I think.
Okay, here's reason number two. We're talking about reasons your retirement calculations could be wrong. Do you know the amount of money you will spend every year from the day you retire until the day you pass away? Now, the interesting question here is, Stan, there is no expiration on your birth certificate. So
Correct.
how do you figure that one out?
You can't. It's an impossible number because you don't know. But what you do know what you're spending, or you should know what you're spending a couple of years prior to the quote retirement, whatever that dollar amount is. And there used to be the so-called rule of thumb, you spend 60, 70% of that money in retirement. We threw that rule out years ago. And we say basically whatever you are spending prior to retirement, a year, 2, 3 prior to, that's what you're probably going to be spending in retirement. Not less, probably the same, in some cases more, because you have more leisure time, you're going to eat out more, you're going to travel more, especially in the early years of retirement, because you're more physically able to do those kinds of things. So we try and gear the dollar amount to just about the same amount that they have had prior to the couple of years before retirement.
Lee, when you're figuring this out, is there a life expectancy chart that you use to try to help them figure out what they're going to spend, or how, so that they don't overspend?
There is a life expectancy chart, but everyone's health is very, very different, needless to say. And you have to plan, again, especially if you have longevity in your family, you have to plan today on living, if there's a couple, somebody living till age 100. I'm sure you know many people, if you don't.
I can think of 2 already that I know that live past 100, right?
We know a number of them, probably about a half a dozen to a dozen folks that are at age 100 or very, very close today. So in very, very simplistic planning techniques, assume age 100 for one, if not both parties of a couple. So we have to figure out how to make sure that the money lasts to age 100, and you have to plan accordingly.
Well, I would even take it one step further. We don't use 100. We use 100 as a guide, but we really shoot for 110. That's the so-called rule of 100. You take your age and you subtract your age from 100. We use 110, and that's the amount of money that should be in risk-related things and non-risk-related things. Lee and I, a couple of weeks ago, had a conference in New York, and when my wife and I were coming out of the tunnel, you come in, all of a sudden you're into New York, and there's this giant billboard, and the giant billboard says, plan on retiring, plan on living longer, and plan on living to well over 100. Big giant billboard. And I said to my wife, they must have been listening to our show, because we've been talking about that
right.
for years and years. So you have to plan for that. And if all of a sudden you get to that point, terrific, you have enough money, to do that. That's our goal in the planning process, using all of the different programs that are available in order to do that, all of the different kinds of places that someone can deposit their money. And there's so many different things and so many different places today that people can take advantage of to make sure that they do not ever outlive their money.
Okay, I'm planning on living till 100. Thanks for that encouragement here. More to talk about here on the show. It's Molotsky on Money. We're here every week at this time, and we discuss a variety of financial issues, of course, all designed to help you and your family. And certainly we have plenty more to talk about here on the show. With Stan and Lee Molotsky, I'm your host, John DeMasi. More Molotsky on Money after these words. Don't go away. Stay right there.
Since 1958, the SHM Financial Group has been providing sound financial insights and strategies for people just like you. Founded by Stan Molotsky, the SHM Financial Group believes in safety, security, and preservation of principal. For more information on how the SHM Financial Group can help you, contact them at 1-800-MONEY-SHM. That's 1-800-666-3974. As we approach certain times in our lives, it's very important to make sure our brakes are not worn out, and we have an exit strategy in the case of impending volatility in the markets. Don't wait until after your next accident. Test your brakes now. Test your portfolio's risk model now. Make sure you are positioned in order to protect yourself. Avoid the next market crash by having your brakes checked. Call 1-800-MONEY-SHM. That's 1-800-666-3974. The SHM Financial Group has been providing sound, safe, and secure planning for over 50 years. Check your brakes now and be better safe than sorry.
Welcome back to Molotsky on Money with Stan and Lee Molotsky. I'm your host, John DeMasi. From time to time here on the show, we put up the phone number, the email address, the website for Stan and Lee Molotsky and the SHM Financial Group. Feel free to contact them if you would like to ask a question or you want more information, or if you would like to sit down with Stan and Lee and discuss your financial situation. They'll be happy to do that. Again, check out the phone number, the website, and the email address. A lot to talk about here on the show tonight. Reasons that your retirement calculation could be wrong. That's what we're talking about here on this particular program, and we have plenty more to talk about here on the show. Right now we are going to do the next edition of the reasons that your retirement calculations could be wrong. And this is number 3. What will be the inflation rate during your retirement years? Lee? I mean, how do we know that one? Because we've had many discussions about the inflation rate.
We had a great show, I'd say about a month or so ago, on just on inflation. And that show showed that, you know, if your needs are $1,000 a month at 4%, you know, 5 years later you need, you know, $1,200 a month. 10 years later you need $1,400 a month. So only at a very simple inflationary factor of 4%, you need a significant amount of money, 40 to 50% more in 10 years than you need today. So inflation is really, really important to factor into many people's planning. I think it's one of the most underutilized or under-addressed issues today. And as we see movement in the 10-year Treasury, which has significantly changed over the last 60 days or so, you're going to see more and more talk about inflationary factors being built into.
Stan, we always talk about this, but we've talked about this 100 times on the radio show, that the inflation rate, or what they tell you it is, doesn't include energy and food. Right. So the inflation rate that the government tells you is not exactly the inflation rate.
Do you listen to the government all the time?
No, not at all.
You have to follow their rules
yeah.
and work within their system, but to listen to that is nonsense. So you have to do it to your own personal situation, and our own personal situation really says anywhere between 7 and 8% realistically.
Right.
Well, you have different inflation rates for different people. If you have kids going to college, the college inflationary rate is 7 to 8 to 9% per year. If you are buying a home, the inflation rate is totally different than if you're retired. If you're spending a lot of money on medicines and doctor's visits and things like that, your inflation rate is different than somebody who isn't conflicted with those kinds of things. So the inflation rate is a guide, but the critical thing with the inflation rate is you can absolutely guarantee yourself that whatever it's costing you today, in whatever combinations of things you're spending money for, collectively is going to cost you more 3, 5, 7, 10 years down the road. So you have to factor all that into your planning. And the amazing thing today is that there are programs available that allow you to deposit money into them and also give you an aside income factor inflation rider connected to it, which allows that program to increase at X% per year, regardless of the performance of your program. based on that so-called inflation rate. So when you come out years down the road, 3, 5, 7, 10 years down the road, with that block of money, it is guaranteed to keep pace with inflation at a modest rate. Modest meaning 3 to 4 to 5%.
So no matter what, it's protecting you against inflation.
That is correct. Or a portion of it,
portion
for that
of it.
portion of that money. That's what I said before. The fascinating thing to me about this business is that the great number of innovative programs that are available that keep constantly being presented that we can utilize in our practice.
Lee, you wanted to add to that?
Yeah, I was going to segue back to that Social Security discussion. Why that's so important to keep up with inflation? We all know that inflation is there. It's underneath the surface of the mud, so to speak, but it is really important in our planning process to include inflation. When we include inflation and we look at the Social Security, that decision as to when to take Social Security, if you're approaching that decision, really, really important to use that Social Security maximization. It could be a difference of anywhere from $100,000 to $160,000 difference over someone's lifetime,
If not more.
if not more. So really take a little bit of time out, include that. Don't just decide, oh, I'm going to take it at age 62 or I'm going to wait till age 70 because I don't need it. It's not that simple. It's really important. From an inflationary adjustment standpoint, as well, to include that in your process.
Well, I'm going to make an executive decision right now, right here on this program.
Okay.
If anybody who is watching this program would like information on that Social Security maximization report, just call our office, visit our website, click in that they would like that information on that Social Security maximization report. And for our listeners tonight, we'll make that available to them.
Our viewers tonight. See, you're back.
All right,
You're,
our
you're on the
viewers.
radio show.
Oh, I'm sorry.
They're
Viewers.
listening and they're watching.
Okay. Sorry about that.
Reasons your retirement calculation could be wrong. This is number 4 tonight here on the show. What year will you and your spouse pass away? The myth of life expectancy tables. And we talked about this before, Stan. There's no expiration date on your birth certificate.
No, I mean, Lee
So-
mentioned it before. I mean, he said, you know, that's all well and good. You have certain guidelines and different kinds of things, but the probability that if you're married, that one of the participants are going to live into their 80s, 90s, into their hundreds gets longer and longer. The list gets longer and longer as we get older, so to speak. So it's important that you plan for that age 100 and 110, and if it happens before, so be it, but at least you're planning for that particular longer period.
In other words, don't say, well, my parents passed away at 74, so that's going to be me, and then you're at 85 and you ran out of money.
Well,
that's kind of one of the mistakes that you could make.
Exactly. I mean, we had a couple in the office yesterday, not a couple, but 2 sisters. And she was, what was she, 81, 82? I mean, she looked like she was 70. I mean, she looked fantastic. And in the planning process, the amount of money that she had and the amount of money that she was withdrawing, if she didn't make a couple of adjustments, there would not be enough money for her to get, quote, to age 100. And that's what our goal was as
You
we
made the adjustment,
revised.
right.
Well, we're in the
Okay.
process of
Right.
sitting down and doing that. So that's the key, to plan for that. Forget the life expectancy table, but plan for 100, 105, and then so be it from there.
I don't want to say this, but I'm going to say it anyway. I think people that have children, twins or triplets, become wonderful or excellent planners. And the fact that you really have
Talk about
to,
yourself. We should
Well-
mention that for those who don't know, he's the parent of twins. That's why he's saying that. Okay.
and girls in particular.
okay.
So people that have or have twins or triplets, for that matter, I know somebody that has triplets. Hello, Lori. So you become really a planner. You have to plan because in order to move the family or the group, you have to be aware of so many factors that go into the planning process. So related to financial planning, we try and encompass all the factors, all the pitfalls. Where can this plan go wrong? And then if things don't go wrong, it's a bonus. If we address all the issues that could come into play, inflation, stock market risk, bond bubble factors, real estate,
International problems.
changes in,
It's a
war,
multitude of
whatever.
things.
All the issues, if you address all the issues and are aware of them and can protect yourself from many of them, then your success ratio goes up significantly.
All right, we have more to talk about here on the show. Reasons your retirement calculation could be wrong. That's what we're talking about. tonight here on the program. Yes, we have plenty more to talk about and some email questions as well. It's Molotsky on Money with Stan and Lee Molotsky. I'm your host, John DeMasi. We're coming back. More of the show after these words. Stay with us.
Do you know what your risk tolerance is when it comes to your investments? Do you know exactly what you have in your portfolio? The SHM Financial Group have developed a very important program called a financial stress test. It's simple, quick, and can help you in your future financial plans. Contact the SHM Financial Group to schedule it. Offices in Collingswood, Voorhees, and Lakehurst, New Jersey. Call 1-800-MONEY-SHM. That's 1-800-666-3974.
As you approach the day you retire, you approach the retirement cliff. For nearly every American, Social Security is a big part of your bridge over the cliff and into retirement. When you have a personalized Social Security maximization report, you will hold in your hands a blueprint for the bridge to carry you safely over the retirement cliff. You will know exactly what to do and exactly when to do it. Social Security Maximization Report. Maximize your Social Security income and minimize the dangers of the retirement cliff.
Welcome back to Molotsky on Money with Stan and Lee Molotsky. I'm your host, John DeMasi. Don't forget, if you want to contact Stan or Lee or any member of the SHM Financial Group, we have the phone number on the screen or the website or the email address. Feel free to contact them. We're always happy to talk to folks who've watched us here on Molotsky on Money. Tonight we're talking about reasons your retirement calculation could be wrong. Let's get right back into the particulars, what we've been talking about here on the show. And this is a good one because when we start talking about it, you'll see why. How much will company pensions and Social Security pay over the duration of your retirement? First of all, Stan, only 17% of the population has a pension. So the other 80-some% don't have it.
Correct.
So that's eliminated.
Well, plus, unfortunately, even those people who have a pension are not guaranteed that they're going to get that pension because it depends on where that money is deposited and who's responsible for making those distributions. And if you happen to live in Detroit or some of the other cities that have gone bankrupt, the pensions from those particular entities are no longer available in the form that they were supposedly thought to be available when the people
So even
retired.
if you have one, you're not guaranteed you're going to get it when you retire.
That's why it's critical that as you do your planning, you plan to take care of yourself and the other things become extra, or the inflationary kicker, or whatever it is that you want to utilize. And we always try and look at Social Security as the inflation hedge against whatever it is you're trying to accomplish, and your own assets are what you're going to live on, and the Social Security income becomes your inflation protection. And fortunately for a lot of our clients, that works out pretty well that way.
All right, we're talking about here reasons your retirement calculation could be wrong. This is our next one is, what are you assured your portfolio will earn over your lifetime? Lee, I guess there is no such thing as assurances, are there?
Well, there are in certain guaranteed insurance-related contracts, there are available today almost private pension-like instruments where you can, as we spoke about earlier this evening, set up a personal pension plan so that while you're waiting to take the money out as a pension, you have a guaranteed cost of living adjustment of anywhere from 4 to 6% per year. So you're getting paid, in essence, you're getting paid to wait until you actually need the money to help you supplement your retirement. So yes, there are guaranteed instruments out there. They come in the form of various insurance contracts, and their cost of living or pension adjustments to the lifetime income benefit is anywhere from 4 to 5 or 6% per year.
Stan, so in other words, should you always be in something when you're going to retire that you have a rate that you're guaranteed?
Yes and no. I mean, you know, every case is different, every situation is different, but you need different things doing different things to take advantage of all the cycles that we are about to go into. So yes, a certain portion of that money may make sense to go into what Lee was just talking about, and other things that are more shorter term, giving you the opportunity to reinvest as you ladder the particular investment structure that you're doing. You have to have a multitude of different things available today. And whoever you're dealing with, they have to be in a position to be able to offer to you a multitude of different things.
All right, we have one more here to go over before we leave you tonight. Reasons your retirement calculations could be wrong. What will be the sequence of your investments return in the first 15 years of retirement? You want to explain that, Lee?
No idea the answer to that, but I can tell you something that, again, we've been doing a number of Social Security retirement planning seminars throughout the area recently, and there's a discussion that we have called sequence of returns. Extremely important to realize the sequence of returns dramatically affects the return of your assets, on your assets. And if the sequence is in the wrong order, you could be in big trouble.
All right, give me the wrong order. What's the wrong order?
The wrong order is to have negative numbers early on in the game plan. So if the first 3 to 5 years are negative and the last 10 to 12 years are strong, you could be in big trouble.
Because you're catching up from the negative years.
Well,
Exactly.
you're gonna,
Okay.
if you, again, we're talking about retirement planning, you're taking out money, so as you're taking out money and as inflation affects those monies, the drawdown and the inflation factor and the negativity early on in the first 3 to 5 years could wipe you out. If those same numbers were flipped so that they occurred at the end, you would have significantly more money. So it's not a matter of trying to figure out when they're going to happen. It's just a matter of protecting yourself from that happening early on in the process.
That's the key, the protection part, especially as you get closer to and in the beginning of retirement, to make sure you do not go backwards. That's the key thing.
If you really think about it, October of 2007 was the height of the market, October of 2007. If you retired October of 2007, we know a number of people that did, for the next year and a half to 2 years,
You were great, right?
no, you
No,
were in
that
big
was
trouble.
when the
That
market
was
fell
trouble?
You were in big
Okay.
trouble.
Right.
All right.
So if
because the market was
It fell apart.
fell apart.
apart.
Okay.
So
they were in trouble.
yeah, right. Unless they used instruments that protected their assets, they were in a lot of trouble.
So as you get closer to that point of retirement, 2-3 years away from it, you should be positioning yourself that no matter what happens to the market or interest rates, you're going to be in a positive position. That's our job. That's our goal, to put people into those kinds of things, to protect their asset base so that, as Lee explained, you don't go backwards to start. You're always constantly coming from being ahead, not from being behind.
So I guess to sum this whole program up, don't listen to your neighbor or your brother-in-law or your sister-in-law.
No offense to the barber, but
Right,
yeah.
Go through this with a professional yourself, your group, or professionals, but make sure that you know what you're doing before you get into it. And while you're into it, you still have to constantly review.
And adjust. Exactly correct.
All right, and with that, we're going to put the wraps on another edition of Molotsky on Money. Don't forget, if you would like to contact Stan or Lee or anyone from the SHM Financial Group, our number's been on the screen, call them, email them, or go on their website. For Stan and Lee Molotsky, I'm your host, John DeMasi. Always a pleasure. Thanks for watching. Good night, Alexa. Good night, Janet. Talk to you next time. Molotsky on Money right here. Take care.
Just as it's extremely important to have your automobile's brakes tested, we think you must have some type of safety net provisions in your financial plan. How are you protecting your bond positions from rising rates? How are you protecting your stock market gains from market sell-off? Do you have the proper provisions in your financial plan to assure that your income lasts as long as you do? Are you keeping up with inflation? Call 1-800-MONEY-SHM to schedule your safety net review. That's 1-800-MONEY-SHM. Not everyone can endure the ups and downs of the market. When planning for retirement, you can ride the roller coaster and take your chances, or you can eliminate the downs by properly repositioning most of your portfolio. If you're 5 years pre-retirement or 5 to 10 years into retirement, it's not too late. As a matter of fact, it's never too late to avoid the next down movement. Call the SHM Financial Group at 1-800-MONEY-SHM or check us out on the web at shmfinancial.com.